Options traders and Cobra trading students, this is Cobra 1 giving you guys a recap on November 26, 2019. Let's just hop right into it. SPY closed at all-time highs, 314.08, up 23%. Higher on the day, the Dow closed up 0.20% and the NASDAQ ended the day 0.18% higher. Gold, as of right now, is currently at immediate support. If we look at it right now, we actually had a rebound. This is at the 38.2 retracement on the Fibonacci's. However, down about 9% after hours into the futures. Bonds on a slight uptick, sitting at support with strong support underneath us. You guys heard me speak about bonds over the last several trading days. Crude oil futures are down about roughly 0.21% at this time of recording, and S&P 500 futures are slightly elevated and higher. Being at all-time highs, what do you guys notice? Yes, we are at all-time highs. Yes, the market is fairly strong right now, but and yes, it is Thanksgiving weekend, but what do you guys know is that there's no volume still in the market. Okay, that's completely okay, because going forward into distribution day tracking, we're currently on 3 within the S&P 500, 3 on the NASDAQ. What does this mean? Those who have been following me from the last previous videos in which I posted, last Thursday we were at 5 on the S&P 500 and 3 on the NASDAQ. As of yesterday, we were at 4 on the S&P 500 and 3 on the NASDAQ. Today we actually had one drop off. It's the one from October 22nd, just because of time. You know, distribution days are considered institutional selling days whenever an index drops below 0.20% or more. In that case, since one distribution day has rolled off, we actually do have a little bit of leg higher to the upside. Historically, overall, if you guys ever look at November, usually the first 2 weeks we begin to sell off and then curve up higher into the holiday season. We are historically into a strong month within the market where we could foresee a little bit of a more push to the upside. You know, being so that, hey, we have distribution days dropping off our list. It does show that, you know, a lot of sectors, a lot of institutionals are beginning to key into actually adding more risk on apparent or cash, money, margin into the actual market based off of certain trades. Sectors and growth levels are beginning to curve and strengthen. And with it also hitting 314.28, this was our expected move for the week. We can see that, you know, it is a holiday season. We've made the majority of that move within the first 2 trading periods of this week. Here we are roughly at 314. We did get a little bit of a pushback off from all-time highs today, but not to say that they can't be exceeded going into tomorrow and maybe Friday's half session. However, one thing to note that I did want to cover with you guys is that looking at the probability cone, I have covered this in the past and actually one of my previous videos. If we look at the probability cone, this regression line dates back, these 3 red lines date back 6 months. Okay, and what does it mean? Regression lines actually hold a value of 1 standard deviation, which is often used within the market's, you know, traded options, and providing a marketable move. Okay, what's expected to be made from what the market's pricing in. So probability cone is showing us a 1 standard deviation, okay, and then we have a 2 standard deviation. Sometimes we can look at a 2 standard deviation. We can see that yes, we are at the highs of the expected move, but we are, you know, also pretty much respecting the 1 regression channel, and it looks like we could possibly move up to maybe 317, 320 short term between now and December of 2019. A possibility of moving up to 323. Or back down to 305, okay, on or before December 20th, 2019. One thing I did want to make, you know, those who actually are watching the market aware of is that, you know, we are sitting at a 34-day, you know, disparity index at the highs, okay? And if you guys look at the line that I just drew out versus the line that I'm drawing out right now, this is support, this is resistance right here. What do you guys notice is that here's our 0 line, which is a median line, showing reversion in actual price that goes on. When we look at the disparity index and we see exactly how it performs, we can see there's a close correlation with how the market performs. Here we are at disparity index highs and we come back down, okay? Market's at its highs with price and we come back down. Here we are at the lows, we go back up. Here we are at the lows of the disparity index and look what happens. We're going back up. Okay, so as of right now, our disparity index is at repeat highs from historical values where they once were. However, I want to say that every single market's the same market, but something to be aware of is that yes, we are at these highs. We need to necessarily break above possibly 315 to move another leg up higher. It looks like it can be done, but there are slight divergences within the market. First of all, look at the volume. Okay, I do like the distribution days right here falling off. That shows that there's possibility for more growth and more risk on environment money flowing into the actual market. But our disparity index does point to a move or a leg possibly lower. Now, I'm not saying that there's no possibility of breaking out. The possibility of it breaking out, can be foreseen. But right now, it's leaned slightly to the downside. Do I think it's going to be a sell-off? No, absolutely not. But I do think that we could possibly see a retracement back downward. If we do happen to break out the 315 range, then gear up because we could possibly head higher to 320, 323 max before actually possibly pulling back from this point right here of resistance. It is something just to be mindful of right now. Implied volatility is still low right now, so those who are actually looking to execute maybe some strangles or some put options further out in date, maybe some back ratios, spreads could do so at a lower premium versus when the market becomes volatile and begins to shift lower. However, I do think that we do have another leg up higher and we can possibly move up higher. As a contrarian, I am actually buying bearish names, okay, bearish trends and bearish stocks within those bearish trends and industry groups down to the downside in anticipation for a move and momentum shift down lower. However, when opportunity presents itself with opportunist trades, I am not against taking trade to the momentum side. Absolutely. For those who actually saw my video yesterday, I did open up Disney, okay? Disney was opened up on a vertical spread and we did take a full 65% profit on return on investment from the actual trade that we were in. Okay, open up the 147s by 150s. Stock went up to a high of 153 before retracing back down off of higher sell value. Now we may come back down, retrace back a little bit. So this play, I took profit off the table. This was done for me. However, before looking to reload back into it, you want to see volume begin to shift back into bullish ranges and things to be aligned. I do think that we can actually pull back just a tad bit, a little bit more. IWN and Russell 2000 covered this yesterday as well too. Okay, let's look at the Russell 2000. Russell 2000 is the indice, okay, to the index that we actually trade on the IWN. We can see that over the past 3 years we retested this heavy resistance area at 1620. Okay, finally breaking out of it as of today. Okay, and retracing back onto support, which was resistance over time. The IWM, okay, we did take this trade right here. We came back a little bit, but it is completely fine. I left this on a back ratio spread, which, if the market decided to turn back down lower, would ensure my trade and allow me a credit of my full premium invested or unlimited profit potential moving upward, okay? Disparity index right now is still at highs, as I had shown you in the market, so it's something to be mindful of is that, yes, we haven't actually broken out of the previous highs yet. There's a slight divergence right here with small caps, but in order for the market to move higher from these highs right here, small caps kind of need to be aligned with the actual market itself. It being so far away from all-time highs, I do think that we can possibly see a 1650, 1700 move in the Russell 2000. Before gearing up and retesting these all-time highs at 173. Okay, so what I did want to cover with you guys is our actual volatility index. Just briefly, for those who are fairly new to trading, the VIX is our volatility index, which measures the volatility within the market that's closely related to the market but moves inversely with the market. All right, you guys can see that if we look back from February of 2018, at these lows right here, our market was at our top highs. And then going forward, we had this VIX explosion, which shot up from pretty much, 11, 12 bucks all the way up to $50. All right, closely correlated with what we're seeing today in the market is likely the same thing. Actually, no, I'm sorry. It is the same thing. It's just a matter of when. It's bound to happen. but it's a matter of when. So when we look at this, what does it mean? I mean, the volatility correlates with the actual market, and the market is derived, from, fear sentiment whenever we do top out at all-time highs. So investors and traders will try to actually buy put options to ensure their portfolio hedges or their trades. They derive when to do so based off of when the VIX is at its lows. Okay, so if volatility measures the actual volatility within the S&P 500 and the market itself, what measures the volatility within the volatility? This is the question that you need to ask yourself, and where these numbers come from are from the VIX futures. All right, so we have seen a slight uptick in volume, okay, whether it's to the buy side or short side. Well, obviously you guys can see that it's to the short side within the futures. Is that 30 days out, we are receiving significantly more volume versus the previous days within the futures. Now, this volume is slightly higher for today overall. It was higher back 7 days ago when we were at these highs right here, and then began to come back down. Now, why is that? Okay, institutionals and firms are actually selling volatility right now. They're selling volatility because people are feeling fear while the market is grinding up higher. Investors and traders and retail investors like you and I are getting scared, and they don't know when the market may pull back, and therefore they're actually buying SPY puts or some sort of hedge or VIX calls to actually ensure their trades. Smart investors and smart money is actually selling VIX futures to us. And what you guys can see is that, yes, as they are selling VIX futures, our VIX continues to grind down lower. So those members and those firms who are selling volatility to us is the reason why we actually see our VIX grinding lower. And for those who actually are selling the VIX, congratulations, you guys are on an actual, the best side of the trade. However, will this trade actually prolong itself and continue down lower? It might, but probabilities are leaned more so to the side of the actual trade and the actual market and volatility index itself spiking up higher. Now, what does this mean when this happens? I mean, think about it, guys. When you guys are trading, all right, if you guys are going short, you're eventually going to have to cover your trade. So all those firms and those members who have been selling volatility will eventually need to cover, okay? And when our market begins to take a downturn, and then investors begin to cover their trades, there's going to be a spike in volatility, which is going to cause another event of what we saw back at these lows into these highs. Okay, why? Because it's like a short squeeze. Essentially, that's what it is. So there is bound to be a market downturn, and when that does happen, it's going to hit us pretty hard because absolutely unequivocally, as of right now, firms are just selling volatility. Okay, and as our market continues to grind up higher, they're selling more volatility. So you think about it, all that volatility eventually needs to be covered. All right, so moving forward, as I stated, our market has been dropping in distribution days in terms of selling, so we'll likely start to see a little bit of more risk on within the market, despite the lower volume than usual that we're seeing right now. I'm not against going against the market, guys. Just that, as a contrarian, I position myself for bigger moves to the downside. With us being at highs historically, when we look at previous price action, the odds of going up versus going down, well, the odds of going down are a lot more greater unless we begin to break out. So when we do break out, it's nothing wrong against taking momentum trades, especially when the market is strong itself and it's aligned. We just have to find where money flow is rotating into and where some of those strongest sectors are. So we can start to see that there's actually a lot of fluctuation within the healthcare sector, and some of the consumer staples are also beginning to trend up too. When we are looking at where actual money flow is going, we can start to see that XLP is breaking out. Okay, technology is still grinding up a little bit higher. SMH did take a little bit of a hit the last 2 days. Financials still remain standard, and which, by the way, let me do mention, since we are on topic, is that yes, even though when we look back at 2018 highs, okay, we are far above 2018 highs. Okay, here we are highs, we drop, we come back and retest these highs, we break above it, and we continue higher. Okay, but XLF we can look back at highs back in 2018, okay, and we have yet to break outside of that range. So although we are creeping back up to it, okay, we can usually anticipate a double top around this point and possible fluctuation back downward. Our financials are still remaining standard. We are nowhere beyond our 2018 highs for our financial sector, which also, if we take into consideration the bigger picture with how our bonds look and being at support and how we are actually breaking outside of this regression channel soon to come, is that, hey, when bonds are on an uptick, financials are really going to be taking a beating downward. And that's just something that we have to be mindful of. So although our S&P 500 is grinding higher, our financials are not grinding alongside with it, and I still remain bearish within that name. Okay, but our healthcare sector overall, especially with the way presidential seatings are, and Joe Biden gets office, you can definitely see a lot more upside to it. We did have a range in which we were respecting for quite a while. If I draw it out, we had a range from pretty much, we had a wedge that ended up breaking outside of its trend, okay, and continued up a path a lot higher, okay, and now it's just going, a strong volume coming in as well too, alongside with the actual sector itself. So we actually start to have to look into some of the sectors or sector names that are actually outperforming. And we can start to see that's kind of where I would actually want to take a little bit of a bullish stance, especially within our market. Being at 3 distribution days, we have to look for the strongest sectors. Okay, if I do find anything on watch for you guys, I will let you guys know tomorrow within the Discord channel. All right, that's all for today, guys. See you tomorrow.